On the trade front, the EU and India have reached a free trade deal after nearly 2 decades of negotiations. The agreement comes as the two powers look to offset President Trump's trade policies through economic ties. Now, European Commissioner President Ursula von der Leyen posting on X that they have, quote, concluded the mother of all deals. Joining us now is Seema Shah. She's Principal Asset Management Chief Global Strategist. Seema, thank you so much for joining us this morning. Lots to get to. First, we're waiting to hear from a response from Washington this morning. What could it be? What could we possibly hear from the administration in response to what's said, this mother of all deals here?
Well, it's going to be interesting how they respond. But I think just looking at the reasons for Europe and India to have this trade deal, I mean, firstly, this has been a long time in the making, so it doesn't come as a surprise. But I think it does tell us that you could see increasing a number of alliances between other countries around the world as we get used to this kind of multifaceted world where economies can't be completely dependent on the US anymore and really need to start thinking about their trade relationships with other partners.
Now, Seema, this also comes a week after we heard those threats on the EU over the potential, buying agreement to buy Greenland. We then heard the framework of a agreement has been made, and President Trump pulled back those tariffs. You say that Washington's growing reliance on tariffs as a geopolitical tool suggests here that trade policy volatility will remain within this administration as part of the framework or feature of the investment landscape. Do you think that this sort of plays out into the future narrative? Will we continue to hear different threats, tariff threats, after we heard that they're making this other trade deal on the sidelines here?
Yeah, I think we can expect this to be part of that geopolitical playbook, tariffs being repeatedly used. We've seen them being utilized even after last week to a number of other countries. But I think the key thing is that markets are really adjusting to this. I think they're learning a number of things. They're learning that firstly, tariffs don't have as much of an impact on growth or inflation as much as they had anticipated, partly because of very strong US profit margins has meant that companies can absorb it. But also that the Trump administration doesn't always follow through with those threats. So I think there's a number of things which are enabling markets to look through a lot of that noise, which has been the right trade. And remember, we have seen this play out last year where we had a number of very serious tariffs being announced, and yet the economy and the market performed very, very well. So I think markets are learning a lot from last year.
And Seema, one of those latest announcements that we got, another tariff threat, was that threat on South Korea, increasing that tariff from about 15% to 25%. Large implications there for automakers, pharmaceuticals. What do you make of that latest threat and how that could fall out into the economy here?
Well, it's interesting that the South Korean market hasn't really reacted very much. I mean, there was a knee-jerk reaction, which was very quickly corrected. As is the case with a lot of these things, we need to wait and hear what the details are. Of course, if they are actually going to be followed through, there could be some impact, of course, for a lot of these markets. But ultimately, a lot of these companies have adjusted to the idea that tariffs could come through. They're adjusting their supply chain. So that dependence, again, on the US is declining. There will be an impact, certainly, if those tariffs go through. But I don't think that they would be as severe as maybe we would have feared this time last year.
And Seema, this is all happening as we're set to get some earnings from major U.S. companies, Microsoft, Meta, Apple, Tesla this week alone. You say that earnings remain the anchor here. Walk us through how investors should be going into these reports and what they should be listening for.
Yeah, sure. And I think to your point, we've had an incredible run up for markets. Valuations are quite stretched. So when we're looking at how total returns are going to perform for this year for equity markets, it really does come down to earnings growth. So that has to be key in terms of predicting where things are going to go. So specifically for these big tech companies, there is increasing dispersion. Investors are looking at the tech company, the tech trade, in a slightly different idea, suggesting that there's more focus on the balance sheet strength, on cash flows, and of course, what are the intentions on AI capex and how it's going to be funded. So we're expecting to see a lot more dispersion within the sector. That doesn't mean that the AI narrative is being challenged very much. It just means that investors are maybe starting to think through what are the differences between the companies. It's going to be very important how these tech companies perform, how their earnings announcements go. That's really going to set the tone for the market. But I would also say that, look, we are looking at a really strong macro backdrop for the US. That does suggest that earnings growth, not just in the tech sector, but along a number of different sectors, should be performing well this year. So from our perspective, tech can do well, but also we do think that there's a potential for broadening out to other sectors and actually to other countries for that matter too.
And Seema, on top of all this, we're also expecting to hear from Fed Chair Jerome Powell on Wednesday afternoon, expecting a decision on the latest potential rate cut hike or potential rate cut. It doesn't seem like they're expected to cut rates here, but you say that eventually we could see additional support from the Federal Reserve. How should investors be going into Wednesday meeting, and what are some key things that you would like to hear from Fed Chair Jerome Powell?
Yeah, I mean, I think there's a lot of focus on tomorrow. Just wondering how Jerome Powell is going to be, if there's any kind of response to the DOJ probe. We're not anticipating Powell to really talk much about it, but really to be focused on the interest rate decision. The market is, I think, predicting with zero chance of a rate cut tomorrow. Certainly that's our perspective too. But we do think that there'll be talk a little bit about the labor market, inflation, maybe taking on a slightly more positive tone on the economy and the labor market. But we do think that as the year progresses and maybe some of the tariff caution around inflation does start to fade around mid-year, that would open the door for one or two more rate cuts. So I think it's about keeping that door open whilst also conveying some optimism about the strength of the US economy.
Fed Chair Jerome Powell in the past has also weighed in on productivity gains, kind of alluding there to the impact of AI. Do you think we could hear anything on that front as well?
I mean, certainly I think this is going to be a key topic for the Fed over the coming months and years. Now, I think even if he doesn't mention it himself, there'll certainly be a question around it because the AI thematics and around the productivity gains, the impact to labor market inflation is going to be so key for central bankers to try and navigate when it comes to their policy decisions. Already we're seeing evidence of productivity growth in Q3 and Q4 already. So certainly that's a part of the narrative. It's probably quite early days for the Fed to be basing their policy choices on it right now. But I would suspect that this is a subject of a lot of research for the Fed, for the Bank of England, for ECB, for a number of central banks.
Seema Shah, thank you so much for joining us this morning. I really appreciate your time.